All right, so thinking about franchises and licenses, and there isn't much of a financial reporting difference between the two, okay? But we're going to go through franchises in more detail, as this is what the exam is known for testing. But at the end of the day, let's know the differences between franchises and licensing agreements. Okay, so these are both business transactions. Okay, so both instances are going to be exchanging money for a certain component of the company's brand. All right, but as far as details go, franchise agreements are going to pertain to a company's entire brand and their entire operation, whereas licensing agreements are merely going to apply to registered trademarks. Okay, so as far as intangible assets go, these are both some of the more sneaky ones that do appear on the company's books. All right, so these are agreements that are very specific, all right, but we do need to know them. All right, at the end of the day, we're going to focus on franchising agreements, and there are two parties that you need to be aware of. There's the franchisor and the franchisee. And we want to understand how we're going to record transactions in the financial statements when this franchise relationship exists. Okay, so thinking about Made Magic, an established maid service company. So Made Magic has a reputable enough brand and a compelling enough business model for franchisees to be interested in paying a premium to operate under their name. Okay, so Made Magic is the franchisor, and our boy Oscar is the interested franchisee. Okay, so in order for Oscar to operate under the name Made Magic and franchise this brand, he's going to pay a total of $50,000. All right, so $30,000 up front, and that's going to be for the cost of using the name, and the other $20,000 is going to be allocated to different costs. Okay, so $10,000 is going to be allocated to training costs, and the other $10,000 is for software costs, right? Maybe Oscar needs to use the company's in-house CRM for sales and scheduling, things like that. Okay, so in addition to that, Oscar has to pay Made Magic 3% of all revenue generated as a franchisee to the company. All right, so we need to understand how we're going to record both transactions to both parties. All right, so again, Made Magic is the franchisor and Oscar is the franchisee. So let's take a look at an example. Made Magic entered into a franchise agreement with Oscar on January 1st of the current year. Oscar agreed to pay an initial franchise cost of $50,000, which was for the use of the brand, $30,000, as well as training for $10,000 and software for another $10,000. The franchise had an expected life of 20 years. Determine the journal entries for both Made Magic and Oscar's franchise business. Okay, so let's start on the franchisor side. Basically, Made Magic is receiving revenue, right? They receive $50,000 up front, and that's going to be recorded as cash coming in, right? But only $30,000 of this is being earned today. And we remember that US GAAP requires that we recognize revenue when it is earned, not when cash is received. Okay, so the exchange of the brand is going to be recognized today. But the $10,000 for training and the $10,000 for the software services that need to be provided are still yet to be earned. Okay, so they're going to record debit to cash of $50,000, credit to revenue for $30,000, the portion that was earned, and another credit to unearned revenue for $20,000, the portion that was unearned for the training and the software. All right, so now assuming 6 months later that the software and the training services were provided. Okay, so essentially this revenue is now getting earned. So 6 months later, we're going to be reversing the unearned revenue amounts. Okay, so this revenue for $20,000 is now getting earned, and the other $20,000 is going to reverse out the unearned portion. So that's now getting debited. Okay, so we're assuming that Oscar has a 3% royalty and earned $500,000 worth of revenue in the current year. All right, so essentially the franchisor, Made Magic, is entitled to 3% of Oscar's $500,000. So 3% is going to be $15,000. That's cash or accounts receivable coming in. Bottom line is royalty revenue is getting recognized to the franchisor. All right, and that's assumingly going to be paid out at the end of the year. But on the franchisee side, things are a little bit different. Right now we're talking about Oscar acquiring the use of this intangible asset on their balance sheet. So the name Made Magic is intellectual property that becomes an asset to them. Okay, so initially they need to record the cost of the intangible asset. And the intangible asset in this case is the franchise itself. Okay, so keep in mind, this will be reported at the present value of the total amount paid. So this isn't necessarily always going to be one lump sum amount. Maybe they're going to pay this in installment payments with interest. Okay, so that might require that you also record a discount or a premium associated with the note. Not going to be the case here. right? It's just a $50,000 lump sum amount. Okay, so Oscar's going to debit the franchise, which is the intangible asset, for $50,000. That's the total franchise cost. Okay, so cash is going out the door for $50,000 for this amount paid. Okay, but we also said that Oscar will owe 3% of total revenue as a royalty. This is going to be recorded as an expense to Oscar on his books. Okay, so the 3% is going to be a royalty expense, which would be $15,000. Okay, so that would be debited, and credit would be cash or accounts payable for the same amount. All right, but wait up, this is an intangible asset. So we need to amortize this, and we're going to be amortizing it over its estimated useful life. Okay, so the total franchise cost of $50,000 is getting amortized over 20 years. So Oscar's amortization expense and accumulated amortization would be recorded for $2,500.